Welcome to Financial Strategies Unleashed with Concenture Wealth Management. My name is Robert Gilliland,
and I'm Mike Alexander.
Welcome, everyone. Today, especially given what's going on in the market and really what we've experienced over the last, I'm going to call it couple years, is volatility. Markets are volatile going up. Markets are volatile going down. The question for you, my friend, is market volatility, friend or foe? Da-da.
First of all, it's a great question. And I'm going to tell you that by and large, it can be a little bit of both. It really depends on your situation as an investor. Depends on how much cash you have to invest that's sitting on the sidelines. So, as an example, if volatility is really high, and just so you know, typically when volatility levels are higher, investments are typically going in the opposite direction and vice versa. When volatility is low, they're typically plodding along and generally moving in a positive direction. But what I would say is that when you see higher periods of volatility, for a lot of investors, it's a great time to be able to put cash to work, to dollar cost average, to be a buyer of investments in that volatility. And all it's really telling you is that there are enough investors and that are uncertain about what the future looks like, and that's what actually creates the volatility. As we all know, markets hate uncertainty. They like to know where things are going.
I would go and change that a little bit. What I would say is that I'm not certain that people actually understand what volatility is. I would argue that if every day the market is going down, that's not volatile. If every day the market is going up, that's not volatile. What volatility is when it is jumping up and down, when the market's up 200 points, down 300 points, up 400 points, down 100 points. And market volatility, which is what happens there, is that creates confusion and that uncertainty. And so the question becomes, is that a good thing or a bad thing? And I think much to your point that if you're disciplined, that volatility can be good, right? On the other hand, if you're not disciplined, that volatility, markets going up and down, that volatility can be bad. And where I'm going with that is that we see it all the time. There's a phrase called capitulation. Mm-hmm. And the way capitulation is when the markets, generally speaking, spike way down, and everyone is calling, everyone is online, everyone's doing everything, and they're saying, sell me out. I want out at all. I don't care what the price is. Get me out. I just want some of my capital back. At that point right there, that is the peak of your negative volatility, right? That's the capitulation where everyone's throwing their hands up. That generally is the time that you want to go and jump into the market.
Absolutely. Those are usually the best buying opportunities are on some of the most volatile days. I think there's been plenty of studies talking about, missing the best 10 days of the market. There's probably some other studies that have been done on missing the worst 10 days of the market as well, of course. The interesting thing about volatility is the way that you talk about it, Robert, is that a lot of times some of your biggest up days also follow some of your biggest down days, right? And so that's the whole definition, right, if you will, of volatility. I think the key thing as it relates to volatility is kind of to your point on capitulation, and that is that it brings about and spurs an emotional response from an investor, right? So the example I would be is if I lost 10% in a month, that means in 10 months I'm broke, right? And so that's a very uncomfortable feeling, and it's one of those things that sometimes can lead. It can lead to that, that capitulation. But volatility exists in the marketplace in a lot of respects, in healthy ways as well. And what I mean by that is that for a lot of investors, it's the uncertainty around the economy or around a particular company or a company's earnings or its prospects. It's that uncertainty that actually creates the opportunity to invest in it. And so sometimes, when you buy something, there's some volatility associated with it until everybody comes to the same conclusion, and then volatility tends to calm down a little bit. And so, back to your original question, can it be friend or foe? The answer is both. And maybe moreover on that is the other time-tested answer, which is it depends. And
that's the way to commit. I appreciate that.
So the reality is that you can get a little bit of both. Volatility in and of itself is not such a bad thing. The way that I like to think of it is volatility is not necessarily something that people can quantify, but they know what it feels like.
Oh, so true. One of the things is we're sitting here talking about this volatility, and the terms in which we're talking about it is in the market in general, right? And so we talk about if you have an index, call it the S&P 500. You have an index and it spikes down, and you have a long-term time horizon on that. Maybe that doesn't bother you. So volatility there may be your friend in that you can go and buy more, because no one likes a sale more than my wife, who likes to buy things on a discount. And if we love investment X and investment X is half price, it's going to go inside there, specifically talking about indexes with a broader market. I do think that volatility in that same type of mentality, I do think that you have to be careful when you're talking about individual securities. A stock is $100, then it's $25, then it's $10. There's probably a reason why you still shouldn't love that stock at 10, right? And so that volatility, if you're look, I bought it at 100 and now it's at 10, heck, I can buy 10 times as much right now. That volatility is probably not good. The markets are telling you
right
on individual securities, not broad markets that are inside there. I'd love to get your take, being a CIMA, Certified Investment Manager Analyst, which means you've had a tremendous amount, I'm probably going to slaughter this, a tremendous amount of training in how portfolio design and how managers and the amount of risk that they go in and they take on. Is what are some times that this market volatility really has a negative impact on people's outcomes?
I think the primary one is when they act in periods of market volatility irrationally. And so the example is there's a lot of different things that can happen in capital markets on a daily basis. Sometimes it's a geopolitical event. Sometimes it's a political event. Sometimes it's something that is specific to a company that takes down an entire sector of the marketplace. I think people have to recognize that in many respects, markets are driven heavily by sentiment, and that sentiment is, of course, impacted by a lot of the data that actually comes at it. And so, I think the idea sometimes is to step away and to say, and to ask yourself as an investor, is this a temporary situation, or is this something that's much more permanent? And certainly as you mentioned, Robert, at the individual company level, there are things that sometimes can be permanent, right? And then there's sometimes there are things that are seasonal or what I would call temporary. They're temporary. Companies from time to time, they miss their earnings expectations. Okay. Sometimes companies issue guidance that's not exactly what the market is looking for, and that results in a disappointment. And that's one of the things that creates some of that volatility. I think the key for most investors is to the degree they can keep a level head, right? Understanding that what you're typically investing in, these are ongoing interests that there's a very good chance that you have a good understanding of them, that you can see when you drive down the street, and when you drive by, you can see that they're not going out of business. Right. And so I think the idea is to not get overly emotional about it. Now, that doesn't mean ignore the fundamentals of what's happening at a company and ignore investor behavior. It's just to say, to take some of these things with a grain of salt. The second thing that I would mention is just recognize that money moves around a lot in the marketplace. So it moves from one company to another. It moves from one sector to another. It moves from one idea to another.
Right.
That doesn't mean that the other ideas are no good anymore, right? And so I think it's just important to keep that level head.
One of the things that I go through and think about as you were there is that if the fundamental reason why you invest in this investment, this index, this sector, this company, if the fundamental reasons have not changed, it's still growing, the economy's going well, so on and so forth. If it hasn't changed, that volatility on the downside creates opportunity. Now, the same would be true if a company or an index or the markets are here, call it 100, and they go to 1,000, then there may be some fundamental reasons as to why you want to. So the question becomes, how the toughest thing for people to do is sell their winners and add to losers. I'm not talking about selling a great company and buying a dog. What I'm talking about is selling a sector or a portion of the market and changing the diversification so you're not out of whack. How do people know, or what's kind of an indication that a way to control the volatility in call it a sector, a way to control the volatility of a portfolio is by reallocating and rebalancing? What should people be thinking about?
Yeah, I think to your point, selling a winner is really hard, right? Emotionally, when something's going up, we always think it's going to continue going up, and when things are going down, we think that one's going to continue going down. Now, if you think about it at the portfolio level, if I have two companies and I buy them both at 100 and one stays at 100 and the other one goes to 200, well, now I own twice as much of company A as I own of company B. And there's a terminology I think that's utilized in the industry, which is called reversion to the mean. But really, all it means simplistically is that trees don't grow to the sky, and that eventually things tend to even out a little bit. So that company that went to 200, there's a good chance maybe that it continues to move higher over a longer period of time. But over the short to intermediate term, maybe the company that's still 100 makes a little bit more sense. And so taking some proceeds from the $200 company and moving it to the $100 company, all things being equal, number one, diversifies out that position and rebalances the portfolio, and therefore takes down some of the risk associated with the ownership of both of those.
One of the things in talking about market volatility that I find kind of interesting is that human nature is they want to beat the market. Specifically, they want to beat the market when it's going up, but they don't necessarily comprehend what it means to beat the market when it's going down. In other words, I may be super, super aggressive while the market's going up every single day, 500 points, and hey, look, I'm great, I'm smart, I'm a genius. But when the market starts to drop and they're down more, that they don't quite understand. The reality is I think investors probably should be thinking about getting somewhere between 70 to 95% of the returns on the upside, but protecting 50 to call it 70, depending on your risk parameters, 50 to 70% of the downside. I think that's where that comes from and where you end up being successful.
Yeah. I mean, I think that's 100% right, Robert. I think the idea is that yes, everybody wants 100% of the upside and none of the downside, right? I don't want any of that. All I want to do is make money, but I don't ever want to lose money. The reality is that most of the money that people make over the long run is by not losing on the downside.
Exactly.
And so there's another term would be the arithmetic of loss. And what it essentially says is that if I lose 50% of my money, then how much do I need? What return do I need to get back to even? And the answer is 100%.
Right.
So the idea is I want to keep myself, from being in a situation where I lose 50% and I need 100% rate of return, because one of the things that we do know is when an investment is down 50%, it's really, really hard to hold on to it. It's one of the very few. I would just say this as it relates to stocks and bonds to maybe to a lesser degree, but it's one of the very few investments, right, that people don't want to buy more of when it's on sale. And that's just human. That is just human nature. And so I think the idea is to try to protect on the downside. We've all probably encountered a 10% loss, but if you have a 10% loss, you only need an 11% rate of return to get back to even. That's much better than losing 50 and having to get 100 to get back to even.
I totally agree. I think when you go through, and as we go through and we look at how portfolios are, where we started this is, and you were, by the way, your answer was very profound. Market volatility, is it friend or foe? The answer is yes.
Yes.
Depending on where you are. And I think that's what becomes very, very important, is understanding that time frame and the income that, or the outcomes rather, the outcomes that you need from those investments. So if you go and you box your investments short term for the next 5 years, you probably can't. Volatility is probably something that is very, very negative to you. In the intermediate term, volatility is, I don't really like it. We need to make sure that we're managing it. In the long term, volatility may be something that's good. So you go look at it, friend or foe. In the short term, volatility clearly is a foe. I need this money in 18 months because I need a down payment for a house, or I need it for an income stream or something like that. Volatility, no bueno. Intermediate term, longer than 5, call it 5 to 10, volatility, hey, I don't like it. Maybe we need to adjust. It's really neither. Long term, depending on the allocation, where it is, being able to manage that, volatility definitely can be a friend. Would you agree with that?
I would agree with it. I think for most investors, they're just looking to get from point A to point B in the smoothest ride possible. So maybe they don't want excessive amounts of volatility associated with their portfolio, but that's something that can be managed. You can't eliminate it, can't eliminate volatility. It's going to always be there, but you can manage to it. And I think that's what makes it a lot easier. An investor who can stay invested is a successful investor. An investor who can't is really at the whims of the marketplace.
That's gambling, right? That's gambling.
Indeed, sir.
And with that, thank you very much for listening to this podcast. Make sure you like and subscribe. If you found some value in this, send it to someone who maybe doesn't have access to it or you haven't shared it with. Absolutely would appreciate that. The other question I'm going to ask is, or request is, if there's something that you liked or a topic that you would like for us to discuss more, please throw it in the comments. We absolutely want to make sure that we're providing a value inside there. And that we look forward to talking to you next week.
See you next time. Thanks.
All right, so let's take care of some legal stuff. As a representative of Sanctuary Securities, Inc. and an investment advisory representative of Sanctuary Security Advisors, LLC Securities, offered through Sanctuary Securities, member FINRA and SPIC. Advisory services offered through Sanctuary Advisors, LLC, an investment-registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities and Sanctuary Advisors, LLC.
This podcast is for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. The content is developed from sources believed to be accurate. No warranty, express or implied, is made regarding the accuracy, adequacy, completeness, legality, reliability, or usefulness of any information.
Opinions expressed are subject to change without notice and are not intended as investment advice or to predict future performance. The views expressed herein are not necessarily representative of Sanctuary Securities, Inc. or Sanctuary Advisors, LLC and should not be interpreted as investment advice.
Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit against loss in periods of declining values. Past performance does not guarantee future results. Any investment discussed may not be suitable for all investors. Investors must take their own decisions based on their specific investment objectives and financial circumstances. Consult your financial professional before making any investment decision.
No part of this communication is intended to be construed as tax or legal advice. Please discuss your specific situation with a qualified tax or legal professional.